So in our last video, we talked about the wealth maximization account and looked at some of the benefits. And there was an emphasis placed on the liquidity aspect of this account. So let's dive a little deeper into that and see what that looks like. So we've got our life insurance policy, and the emphasis is on the cash value accumulation. And in this example, I'm going to use $100,000 of cash value. We've got our earnings rate up there. Now, we have the ability to borrow against our cash value. So in this case, I'm going to use $20,000. And we're going to look at an example of real estate here. So again, to recap, wealth maximization is the only financial vehicle with a loan provision, and that loan provision permits growth and utilization. So our money is growing and we have the ability to utilize it. Okay. So for this example, we're going to look at a 5% loan rate, and just for good measure, we'll look on the low end of our historical average growth rates, so that we can compare kind of. Well, you'll see what we're doing here. So we've got our growth rate over here of 4%. We've got an interest or a loan rate of 5%. So at face value, this says, hey, it looks like we're losing 1%. Well, that doesn't necessarily have to be the case. Let's take a look at what I'm talking about here. First, we've got to understand the difference between simple interest and compounding interest. Now, some examples of simple interest are going to be a mortgage or an auto loan. Basically, at the beginning of the loan is when the greatest amount of interest is being charged, because your loan balance is the greatest at the beginning of that loan. So as you make your mortgage payments, or as you make your car payments, then a little bit is being paid to principal, and your principal balance drops a little bit, and so the interest charged is a little bit less, and the further along in time you go, the less and less interest you pay for that loan. So compounding interest is almost exactly the opposite. If we have a balance and we earn interest on it, that interest rolls back in and is added to the original savings balance, and then we earn interest on that interest. So with compounding interest, as time goes on, the balance gets bigger and bigger and bigger. So let's look at some numbers here, and we'll pull in $20,000 and look at an example of $20,000 at 5% over a 5-year period. So this is a $20,000 loan at 5% over a 5-year period versus having $20,000 sitting in an account earning 5% over this 5-year period. Okay, so this $20,000 loan at 5% over a 5-year period is going to cost us $2,645, assuming we're making monthly payments back over this time frame. And if we were to have $20,000 sitting in an account earning 5% over a 5-year period, the growth on that $20,000 is actually $5,526. So we have a gain there. If we were able to leverage that $20,000 instead of taking it from an external source, we have a gain of $2,881. Okay, and over that 5-year time frame, that $2,881 is a 14.4% gain on that $20,000. Okay, so imagine being able to take a policy loan from our cash value, and as long as we make a payment back, as long as we're making consistent payments back, coming out ahead. Okay? Now, it's one important note here. If you do not make any payments back or service that loan at all, then a simple or amortized loan will become a compounding loan. So it's very important to be honest, be an honest banker with yourself, because this is considered your personal banking system. So it's very important that you're an honest banker with yourself, and you make sure that you are servicing that loan or making repayment. So in our example before, we actually didn't use 5% growth rate. We used a 4% growth rate. So if we're using a 4% growth rate and a 5% loan rate, do we still come out ahead? And the answer is absolutely yes. Because at 4%, that $20,000 still has $4,333 of growth. Now here's a question for you. Did we only have $20,000 of cash value in our policy? And the answer is no. In the example, we actually had $100,000. So if we're compounding at 4% on $100,000, that's actually a gain of $21,665. So even in this example, using $20,000 of our policy, or leveraging $20,000 of our cash value, and making a consistent payment back, we still come out ahead $19,020. So back to our example here. 4% growth rate, 5% loan rate. Are we losing 1% on this transaction? And again, the answer is no. We're actually gaining $19,020. Okay. Now, of course, in this example, we used a piece of real estate. So we're using the cash flow from the real estate to make this loan repayment. But the cash flow on real estate does not end once that policy loan is paid back. So we actually still have the additional cash flow from our investment. Okay. So let's recap here. The wealth maximization account is the only account allowing simultaneous accumulation and utilization. Okay. The loan provision allows us to deploy the insurance company's money while our cash value position continues to grow. So now the question comes in, if you could use the money that you're already saving, how would you use it? What do you feel like you're currently missing out on? So you've got your retirement savings, your long-term savings. Do you feel like there are maybe possibly some real estate investment opportunities that might come along that you can utilize? Are there other business opportunities that you might be able to capitalize, or maybe some private lending? Could you be using your long-term savings and also pay for some college? Okay, or is it a good place to store your emergency savings? Okay, and then ultimately, if you had a personal banking system, is this something that you could teach your kids and your family? And could they use this family banking system as a way to continue to perpetuate not only wealth, but also the intelligence that goes along with how to use it? We'll see you in the next slide.